Hello and welcome to this week's Australian Stock Market Report. Now this week we're going to look at cryptocurrencies and what the Commonwealth Bank announcement last week means to those wishing to trade them. Then we'll get into the Australian stock market so I can share with you my thoughts on where it's heading, along with answering your questions and looking at stocks for you. I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now before we move on, thank you for showing your support for our channel and hitting that subscribe button. And remember, as you subscribe, click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune into our live Australian stock market show, which is on every Tuesday 7 to 8 p.m. Australian Eastern Time. Now this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Now, there's an increasing number of Australians entering the world of cryptocurrencies in the hope of chasing high returns. Yet, many are blissfully unaware of the inherent risks involved. Now, recent research suggests that 1 in 5 Australians now either are investing in or intend to invest in cryptocurrencies in the near future. In response to this, the Commonwealth Bank announced last week that it would launch a new service that allows customers to buy and sell crypto assets. This follows ASIC's announcement in July that it is looking to regulate cryptocurrencies and crypto assets as outlined in the paper titled Senate Select Committee on Australia as a Technology and Financial Centre. Now, until recently, trading cryptocurrencies was considered very high risk as it was largely unregulated, which encouraged dodgy practices by some providers. However, the news last week by CBA and the intentions of ASIC to regulate this market does add some respectability, which I believe will reduce some of the risk Australians have been subjected to when trading cryptocurrencies. That said, many investors fail to learn from the mistakes of the past, and cryptocurrencies are just the latest vehicles investors are jumping into in the hope of making some quick gains. In the last few decades, investors have chased futures, options, foreign exchange, contracts for difference and tech stocks, together with a number of dubious schemes. Yet the vast majority of investors purchased these products with little or no research or education because of the lure of huge gains. Now, they failed to achieve the spectacular profits they were hoping for. Now, the number one rule of long-term success in any market is to understand the vehicle you are investing in and to manage the risks of that investment, and the crypto market is no different. Now it's time we get into what happened on the market, so let's get into what were the best and worst performing sectors last week. Well, the best performing sectors included communication services up 4.64%, followed by healthcare up 3.93%, and consumer staples, that was up 3.76%. Now the worst performing sectors included energy, and that was down 1.9%, followed by materials up 0.3%, and financials, that was up 0.58%. The best performers in the S&P ASX Top 100 stocks, well, they included Charter Hall Group, which was up 11.25%. This was followed by ASX up 10.42%, and REA Group, that was up 10.41%. The worst performing stocks, they included Virgin Money, and that was down 13.7%, followed by Domino's Pizza, that was down 13.67%, followed by Westpac, and that was down 12.15%. Now, before we get into talking about the charts, remember, if you want to understand the stock market and have more control over your trading, then you can get a copy of my first book, How to Beat the Managed Funds by 20%, for free. All you have to do is pay the shipping. Now, to get your copy, visit our website, wealthwithin.com.au, or give us a call on 1300 858 272. So what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks that you've chosen for me. Well, what an interesting week it was on our market last week. Friday really did take off like a rocket, and it really is a positive sign for our market. But we still need to have some caution around what's going on at the moment. But let's go and have a look at the charts to see what we can actually see and how we can ascertain what the future will be like, or what may happen in the future just by looking at the charts. Now on your screen is my normal monthly chart on the left and my weekly chart on the right. Now I'm going to show you another chart in a minute as well. Now if I just bring up the monthly chart, you can see the angle of this whole trend is just folded over a little bit. So we can see here the last sort of 4 months, there hasn't been a lot of action on our market. It did come down. That was about 5.5%, or nearly 6% on our marketplace. October was very much indecision that we've seen. I keep talking about a lot of indecision on our market. So we saw October open at 7629 and closed at 7639. So the market pretty much went 10 points in the whole month, and in closing from September was 7629, as you can see there. So really not much movement there, as we were back where we were right back there in July. Now currently we can see here is November's bar with the high of 7797. Look at that one, 7786. So therefore we've broken above that previous bar there, so we've made a new high. It's not quite close to the highest close we've seen. The highest close we've seen so far is at 7823. So you can see 7823. This one's currently closing at 7777.20 points. So not quite the highest close, but that is a real positive sign there that I really do like on our marketplace. Just looking at the weekly chart, just to sort of give you a bit of an overview, you can see here that whole indecisiveness right through those last few months there, where the market's just really hasn't really picked a direction. And it's really interesting to see when the market's not picking a direction, you know, whether it goes up or down. But we're seeing a beautiful move up last week, and the strongest move, if I really bring that up, you can see this is the strongest bar. Look at that one, 160.9 points. Opening on its very low at 7639 and closing right near its high. Its high for the week was 7797, closed at 7777, as I mentioned just before. And you can see even a weekly close, it's the highest weekly close since this one back right in the early September there, where it closed at 7826.7 points. But really strong looking bar there. Now if I go into a daily chart, you'll see what actually happened. Here's the whole week unfolding. So we've seen Monday there, a nice move up. Tuesday down. Wednesday, nice strong bar. Thursday, nice strong bar. Friday, but it did come back off a little bit from that high there. Remember, we said the high was 7797, so it came back, about 20 points off its high. So we've had 1, 2, 3, 4, 5 bars in this move. I wouldn't be surprised if we see 1 or 2 days down earlier in this week before we start to move on. And we've only had that 1 week down through here, which was interesting. I thought this last week could have been another red bar, and it would have been fine for me. But right now, I think the probability could be it's really starting to swing towards the market. Will move up and move through that all-time high that we saw back in August there at 7902. So I do like the market. The only challenge we've got on the marketplace, while I'll go to the next chart, is looking at the top stocks. Last week, if we look at the sectors, and I'll show you that in a second, materials and financials didn't do anything. But I want to show you something before I get into that. Now, if we go back on our market, so back to 2011, we can see here's 10.67% fall, 11.84% fall, 7.62% fall, 9.7% fall, and then a 20% fall down into 2016. Then the next move, we've seen 9.7, 5.2, 6.75, 15.47, and then this one about 6.93. So we're seeing this is the COVID meltdown in March last year. Now, since then, we've seen the market. The angle of this move is a lot stronger than these moves, and you can see there. This is, if I use my trendline tool, you can see the angle sort of through there. And if I move that over here, you can see the difference in the angle already, can't you? How fast this COVID move has been. And this is what has worried me just a little bit. What tends to move up fast will come down, but we've seen a lot more participation in the market by retail investors pushing this up. But looking at the downward moves, we say 6.57, 6% and 5.77%. So we haven't had a bigger pullback like this 15.47. We haven't had like a 23. But normal sort of markets is this sort of thing. Normal markets. Eventually our market will settle down into a normal rhythm. But what I wanted to show you here, between this big pullback of 20% down into that February 2016 and this low in December 2018, which is a couple of years or nearly 3 years, you can see there, if I bring that up, you can see there that was 34 months in total, if you can see down there. Currently, this move is only 18 months through to that low. So we're in month 19, we're now in month 20 of that. So this is why I expect our market's not going to crash anytime soon, but I think this is the last move up, and it may start to fold over and be a little bit slower and might go back to more of an angle of this. Once most if I can get my mouth to work properly, once most of the money's in the market, then what will happen is the bull market will continue, but there won't be the volume of money going into it, if that makes sense. It'll probably slow down a bit. So we might see this actually slow down to a little bit more sustainable pace, but I really don't think we're going to be, probably the next 12 months will probably be really good. I think 2022 our market will be really, really nice, but 2023, 2024 I think we'll find a peak and then start to move down into another major move. It'll be 15, 20% move. We are starting, we're not in the time frame for that yet, but we will have a bigger move down. I just want to show you our sector indices, if I can bring them up. Not that one, that's this one here I want to have a look at. So you can see here and look at the sector indices, and I just want to quickly show you this. You can see here materials for the year are down 5.15%, where financials is up 26.3%. This is pretty much, these are the sectors that have really pushed our market this year. This is from 1 January, so communication services, financials and consumer discretionary. Our market would have gone more except for materials being there, because financials is the biggest player on our marketplace. It's over 30% of our market is financials. And then materials adds to it. That's the second biggest one. And between the two of them, it's nearly 50% of our market is financials and materials. If I go down to last week, we have a look at this and we can see financials was up 0.94, while materials was down 2.87%. If materials had have been flat, our market would have performed even better, but these two aren't driving the market, as you can see there, with financials only up 0.94. Energy was down 7.49. What was driving our market last week was healthcare, communication services and consumer discretionary. Now we'll go back to the yearly one. So communication services is the best performing sector this year so far, and with financials just slightly behind it. Generally the big sectors, or the sectors that perform the most in any one year, don't perform the best in the next year. That's generally, it's not an absolute, it's a general observation. It's unlikely to see financials and consumer communication services achieve these sorts of returns next year. They may drop back to maybe 10%, 12%, I don't know, but they will slow down a little bit. So it's looking for opportunities will come from these bottom areas, from industrials, consumer staples, information technology, energies, utilities, materials. This is where the opportunities are likely to come from, because they haven't performed as well as portfolios switch around. Because remember, the big end of town, they're looking for value in terms of where they're going to invest new money coming into the market. And if they see, consumer services really, or communication services more fully valued, they're going to look for opportunities elsewhere, which could be in materials, it could be in utilities, it could be in energy. So that's what we need to look at, is where we're going to put our money into next year, and are we going to adjust our portfolio. So don't be surprised to see some of those good sectors and those really, really good stocks start to come off a little bit and move the market up. The other thing I wanted to look at, or talk a little bit about, is looking at the top 20 stocks, because they really drive our market, and we do need to see whether they will continue to drive that through to next year. But last week we saw the small ordinaries and the mid caps driving our market, not necessarily the big stocks, and we need to watch that, because if that continues, that will signal the slowing down of our market, and also it'll actually sort of signal that we need to be careful that the market may fall away. Because generally when you start seeing markets peak before crashes, you see the big stocks, they'll all start coming off and give us sell signals before the mid cap and small caps. So what actually happens is people look for value elsewhere in smaller stocks because they think there's more value there. So they'll be rising and pushing the market higher, while the big stocks are giving us those sell signals saying we're fully valued. But the inverse is correct after a crash. The big stocks are ones take off first, and the small caps and the mid caps, so those sorts of stocks will go second. So it's not something that's worrying me right now. It really isn't worrying me right now, but if it continues on for a long period of time, then it might start to signal that we may come down into a bit of a pullback on our market. It may be the 8 to 12% that I was expecting. So again, you don't need to worry about it if you're using good stop losses and you've managing those really well. Any market pullback is irrelevant. You're just going to be able to handle that quite easily and get into money. And I know there was a quote or post on our Facebook, our YouTube page last week from somebody saying, when he uses stop losses, I think it was a gentleman called Chris, I think he said, when I use stop losses, I lose a little bit of money. When I don't use stop losses, I lose a lot of money. And it's so true. I'd rather lose a little bit rather than a lot. And quite often what happens when people don't use stop losses and their portfolio or their stocks fall heavily, what they do is they just hang on to them, and then they're losing opportunity cost. They're losing the opportunity to be in stocks that are rising rather than falling, and they lose time. They lose a whole lot of things. And yes, there's the whole mantra, if I don't sell, I don't lose. And that one keeps more people broken, giving them poor performance on their portfolio than anything else I've ever seen. The next one is dollar cost averaging, which people still follow and still do. And I know I still get people asking questions about that. Can I add to this stock, or should I add to this stock? And the answer is generally no most of the time. But anyway, that's my take on the market. But let's get into the questions that you've got for me. Alrighty, the first question we have is from Chris, and Chris says, what are your thoughts on REITs in general? I no longer have any, but I'm looking to go back into them. Can you look at CIP or any other REIT as an example? So I'm going to have a look at CIP for you, Chris. REITs. I don't mind people investing in REITs because they can be good investment. They tend to be good plotters, if that makes sense. Looking at returns on them, they generally don't have the returns of like a BHP and a Rio, but they can be great for your portfolio. They could also give you good dividend yields and everything else. But I just treat REITs the same as I do any stock when I'm looking at it. What am I looking for my portfolio? So if you want to use a REIT, that's great. For people that don't understand REITs, it's basically real estate trusts. That's what they are, listed on the exchange, so they buy real estate in that. So, and that's what a REIT is. But we're going to go and have a look at a CIP for Chris. Now on your screen here, on the left is a monthly chart, and on the right is the weekly chart as normal. But let's go and have a look at the whole history of this stock. And here's what you can see. They're generally quite good trending types of stocks all the way through there. I mean, obviously that's the COVID blip through here, and there was a lot of selling on real estate through there, because obviously in lockdowns and everything, if you're looking commercial properties, you're going to see that people are being a bit scared about what's happening. And there's a lot of office buildings in major capital cities that are empty because the whole staffing requirements are changed. There's a whole restructuring of that whole industry. Shopping centres is another one where shopping centres are pretty much bare, especially in Melbourne here for the last couple of years. But you can generally see how it's good sort of trending, how this market sort of trends. And nice solid, we don't get those spectacular runs that just go there, but it does look good. If we look at just a bit of a return here since January this year, you can see here, this REIT, Centuria Industrial, is up 39.86%, so it can do quite well. Now it's up 26.46%. So it's pretty good with comparing, what we're talking about in returns on some of those indexes in the marketplace. So it is doing really, really well. Right now, I do like this at the moment. It could be just pulling back just to ease off on the momentum. If I look at that, you can see here it's fallen about 12.78% through there. That's not an issue to me. I don't think that's any suggesting it's going to fall big time. That's 16.47%, but it just has these nice little moves. If we start seeing a green bar through here, Chris, in this week and next week, I think that'll be fine. I think it's a nice looking stock, so I wouldn't have a big issue with you if you decided you wanted to have this be your portfolio, because I think it probably could trade higher based on what I'm seeing right now, but nothing too much to worry about. But just to be mindful about why you're buying a REIT specifically as opposed to any other stock. I'm not saying don't do it. I'm just saying is, because some people say, I need to buy a bank, and I need to buy a materials company, I need to buy a telco, I need to buy an insurance company, I need to buy X, Y, and Z to balance out my portfolio. But to me, when I ask people, do they want to own stocks going up or down, and they always go up. And to me, it doesn't matter really what you have in your portfolio as long as they're going up, and get out of the ones going down. Would I put all four of the big four banks in my portfolio? No, because I'm probably not going to have buy signals on all four of them anyway. And do I deem that as high risk? Not really, as long as you've got stop losses on it. And this is the myths that go out there or perpetuated by the industry. They're saying, don't ever buy big four banks, and don't buy BHP, Rio and Fortescue at the same time. Well, if they're all of those three are going up, why wouldn't you own them? Because most of the industry they don't use stop losses, and they don't expect you to use them. And so that's why they talk about it's higher risk to own more concentrated portfolios, and maybe owning 2, 3, 4 banks in your portfolio rather than maybe one. If you've got stop losses on it, you're protecting any downside risk. If they do fall, and you buy something else. That's really the provision I keep saying to people. Would I buy 4 banks for a portfolio? No, I wouldn't. We'd probably have a bit more stocks in other ones, because I generally don't find all 4 banks will trade at the same way and give me buys at the same time anyway. So, but if you get the point, it's about balancing out your portfolio of more of the number of stocks you have in it with 8 to 12, like I talk about in my book, rather than specifically what share, what market that is, or what index that, what sector that stock is in, if that makes sense. But thank you for asking the question, Chris. The next question we have is from Bratz Babes, who says, hello Dale, can I please get your thoughts on AMP? My understanding with my limited experience is that it may start a steady climb if it manages to break through its current resistance at $1.20. Overall, AMP has been trimming the fat over the past few years and is consolidating its business. She says, I do own this stock since May this year, and it's been seesawing plus or minus 10% on my buying price of $1.09. Your expert opinion, highly appreciated. So let's go and have a look at that. So Bratz Babes has bought AMP at $1.09. So we're going to have a look at that now. This is one of the most frustrating stocks on the marketplace, or has been for quite some time. I'm just going to put a horizontal line on this at $1.09 so we can see where that is. Let me just keep bringing up. We're at $7. Oh, there we go. Pretty close. Right through there. So bought right through here. No, May. Where we got May? Oh, so she bought right over here. Bratz Babe bought over then. So this is what we're saying here. So she had this up and down moves. And at one stage, if I look at that, so $1, and if I just bring that over here, let me just do that again rather than click on 2 tools at the same time. Let me just click there. And looking at this from that point there down to there was 18.8% fall there. So there's 2 things there. I would have exited this stock after your buy price, but I understand you're more of an inexperienced investor trader, and you did mention that in your email. So I would have exited. There's a few different reasons why I wouldn't have bought right there. That's a high risk place to buy because there's absolutely nothing there telling me that this stock is going up. So I'm not sure what research you've done to determine why that's a great place to enter. AMP has these a lot of false moves. It moves up and then goes back down again, moves up and goes back down again. So is this another one of those moves? Maybe, maybe not. Now we've seen this move through here last week. Very good, strong move, broken through that previous high. Hasn't broken through that one yet, but here's we got to move up there before it fell away again. And we have seen that before. It's broken through previous highs only then to turn over, and you can see if I go through this, AMP has spent most of its life going downhill, and that's pretty much just what AMP's done. So you can see there. I'm going to go onto a monthly chart of AMP just so you can see it a little bit easier. This is the history of AMP from the day it floated all the way down to here, and it's just coming off its lowest prices ever. So yes, it has been doing a lot of cleaning up the deadwood and all those sorts of things, and it has been in the media lately. Do I consider this a sign to get into it? No, not yet at the moment. I still think this is a higher risk stock to own at this point in time. Do I think, this is a big signal for me to get into the stock? No, I would rather see this thing move a little bit further and come back down. So what I would be looking for is, before I would get into it, when a stock's been falling for this many years, I mean, we're talking about back into the 90s, we're talking 1998. If I go right back to here, that's 1998. If I get rid of that. Sorry, 1998. So it's been really travelling down, but in that period of time, it's had some beautiful up runs where this one here, if you see it, rose more than 100% through there. There's 300% rise through there, and this rise through from here, it was 50, 60% through there. So it can rise when it does rise, but if you hang on to it, it's not a buy and hold stock at the moment. So looking at this stock hasn't proven to me that it started to go up yet. So again, I think your entry into it was probably a bit premature. What I want to see is something like this, where it falls and stops falling. Oh, I did that wrong, didn't I? I'm having a good day today, aren't I, with my little tools here. So it moves up, comes back, and I keep clicking the wrong button. And try that one again. One more time, last time, moves up somewhere, comes back down, makes a higher trough, moves up, and then moves through here. And I would rather buy somewhere up here, even 20, 30, 40% higher than what you've bought in, just so I know it's going up, because otherwise you could catch a stock that might be doing exactly the opposite. So what AMP might do, it might do something like this and then do that again, and then just keep doing that and go lower. Because could AMP go lower? Yeah, it could go lower. Could it go higher? Yes, it could. But right now it's all about risk, about what you're doing with your money. Now, as I said, you're still in a losing position, and you're not so bad now that it's picked up from where your buy price was, because it is above your buy price at the moment, which is great. I would just set a stop loss on it, that if it does start to fall away, then start to exit that stock. But just hang on to it right now, because you do have it and you are in profit. Would I be taking a brand new position into AMP today? No, I wouldn't be doing that. I would be waiting for what I just showed you before in the chart. Is I want to see a higher trough on that chart, just to really make sure that we are seeing it an uptrend. Now, on these recordings, and even what Janine and I do on our live show, we're just scratching the surface of technical analysis, and we do that. We could do massive amount of work on these charts and put a whole lot of stuff that would just spin most people's heads. And seriously, we could do that. But the point is, it's not relevant to most people, because most people watching this show and watching our live stream that we do every Tuesday night at 7 to 8 p.m, they're more beginners and they're more investors, and doing heavy technical analysis just would not work for most of these people, because what our goal is to help you make money and help you really get started and really enjoy the market. And I find too many people go and look at these highly technical videos on YouTube with these guys putting all these tools on, but most people don't understand them anyway, and most traders don't understand them. They just go, wow, that looks really good, and then they jump into these stocks, and then they're really hit and miss where they're trading. And how do I know that? Is because every day we get people who have been watching YouTube videos for years and watching some of these highly technical, where they're putting all this work on charts and talking about it, and these people come to us and they're very hit and miss in their trading, and when I start asking questions, they don't really understand things. So so I'm just saying why we keep everything really high level is to help you, because if you can't understand what I'm talking about and what I'm sharing with you, then I'm at too high a level for you. And most of the people watching this are, that, as I said, beginners or investors, and that's probably about 80%. If you are a technical analyst and you're a trader and using technical analysis, you read more in between the lines of what we're talking about and what we're doing on those charts anyway for yourself. So, but we also ground you in some really good solid information. But so hopefully you've enjoyed those questions. Some weeks we get lots of questions and we get way too many for me to answer, and other weeks like this week we've only had a couple of questions. And mainly comments. But if you do have a question that you'd like me to answer, just subscribe to the show. Make sure you're a public subscriber, and we'll answer your question. Then just stick your question in the comments section below. But let me ask you a question before you go. What do you think the Australian market will do in 2022? So next year, will it be bullish or bearish? So what's your opinion on that? Will it be bullish or bearish? And why do you think that? So don't put down bull or bear. Tell me bull or bear, but why do you think it's going to be bullish, or why do you think it's going to be bearish? So I'd love to hear your thoughts, and we'll talk about it next week. Now remember that we do this Monday market report every single week. We also do our live stream every Tuesday night, 7 to 8 p.m. So I look forward to seeing you tomorrow night at 7 to 8 p.m. Australian Eastern Time. Hit the subscribe button now, click the bell on the right of it just to show your support for our show. Also give us a big thumbs up. Please do that. That helps us support you, and you support us and we support you. It's a really good relationship. I'm Dale Gillham, the Chief Analyst here at Wealth Within. For now, goodbye, good luck and good trading.